Welcome to This Explainer. Today we are popping the hood on what honestly seems like an impossible financial mystery hiding inside American Express's latest quarter. We're going to dive right in and look at a company that is somehow seeing its customer spending grow, its earnings grow, all while its actual risk profile seems to be falling. Let's kick things off with the absolute biggest number on the board. We're talking about a staggering $455.8 billion in card member spending in just a single quarter. That's a massive 9% increase. Now, just to be super clear, this number isn't American Express's actual revenue. It's basically all the money flowing across their entire network of cards. You see, the more customers swipe, the more chances Amex gets to make money. So when you see spending jump up 9%, the very first question you gotta ask is, can they actually turn that massive volume into even faster revenue and earnings growth?
Well, here's where it gets really interesting. Revenue didn't just match that 9% spending growth. It actually outpaced it, coming in at 10% and hitting nearly $19.64 billion. This tells us something totally crucial. They aren't simply processing more transactions. They are masterfully monetizing their whole ecosystem. They aren't trying to be just another mass market credit card. Instead, they're extracting way more value out of every single swipe, especially from folks who drop heavy cash on travel, dining, and premium stuff.
And, growing top-line revenue is great and all, but if it doesn't actually hit the bottom line, it doesn't mean much, right? Well, for Amex, it brilliantly translated into real value. Earnings per share jumped 11% to $4.53, and net income rose 8% to $3.11 billion. So let's recap. Spending is up 9%, revenue is up 10%, and EPS is up 11%. That is a seriously healthy growth curve.
But here is the million-dollar question. How on earth did they pull off that kind of growth without taking on massive risk? Because usually in the credit game, lending out more money and pushing for higher spending goes hand in hand with a higher rate of defaults.
Prepare yourself for the jaw-dropping reveal here. While spending, revenue, and earnings were all surging upward, their credit loss provisions actually fell by 23%, down to $1.084 billion. I mean, stop and think about that for a second. Customers are spending more, the company is making more, yet the money they have to stash away for customers who don't pay their bills is dropping sharply. It's an unbelievably powerful combo that completely supercharges their business economics. Okay, so how exactly are they pulling off this high-wire balancing act? In this explainer, we've just covered the massive numbers. Next, we're going to unpack their premium customer machine, check in on macro consumer strength, size up the competition, and wrap it all up by weighing the bull versus bear case. All right, part 2, the premium customer machine, going way beyond the traditional credit card. To really understand the how behind those numbers, we have to look past normal interest rate lending. Amex has 155.1 million cards in force out there, which, by the way, grew by 4%. But the secret sauce isn't just handing out plastic. It's about how much those specific cardholders spend. That builds what we call the ultimate loyalty loop. High-value customers use the card for literally everything to justify their steep annual fees. That drives massive engagement, which leads to increased spending, huge revenue growth, and ultimately that crazy profitability we just talked about. And look at what actually fuels this loop. Travel rewards, airport lounges, exclusive dining. These aren't just cute little perks. They are absolute strategic weapons. They're designed specifically to hook big spenders, millennials and Gen Z, into an ecosystem that is incredibly hard to leave. The Platinum brand is right at the center of this. The deeper you get into their ecosystem and the more points you rack up, the harder it is to even think about switching to a competitor. Which brings us to part 3. How strong are consumers, really? Let's talk about the macro reality. To know if Amex can keep this up, we have to look objectively at the massive debate happening across financial markets right now. Look at this wild divide. On one hand, you've got this booming experiential spending. People are flocking to travel and expensive restaurants. But on the flip side, elevated living costs, borrowing costs, and expensive housing are totally squeezing regular budgets. How can both be true? Simple. The consumer base is fractured. Amex deliberately builds a wall around itself by exclusively targeting that strong experiential side. They don't want to be a mass market solution. They want the premium spenders. Moving right along to part 4, the threat of the competition, and the actual cost of all this customer loyalty. Because, let's be real, building a moat around premium spenders isn't cheap. And American Express does not operate in a vacuum. You've got heavyweights like Visa, MasterCard, Chase, Capital One, and digital wallets all fiercely fighting for a piece of the pie with their own rewards and cash back. The battle today is about travel perks, digital convenience, and merchant acceptance. Premium customers expect premium service, and they absolutely expect those rewards to get better every single year.
And because they have to constantly fend off these rivals, management laid out some really fascinating guidance for 2026. They're targeting about 10% revenue growth, but they are purposefully maintaining their EPS guidance at $17.30 to $17.90. Why? Because they're taking that extra money and pouring it right back into the business. They are deliberately choosing to spend big today on growth initiatives to build a much wider moat for tomorrow rather than just cashing in on short-term earnings.
But, and this is a big but, despite reinvesting so much, they're definitely still prioritizing shareholders. They just raised the quarterly dividend by a whopping 16% to 95 cents a share. That's all part of a plan to return $7.6 billion to shareholders in 2025. So investors aren't just crossing their fingers for future growth, they're getting cold, hard cash returned to them right now through dividends and massive share buybacks.
All right, let's bring it home with part 5. The bull versus bear case, weighing the future.
Every investment has two sides, right? So strictly for educational purposes, let's look at the split. The bulls, they see a perfect storm. They're looking at millennials and Gen Z flocking to the brand, 10% revenue growth, and incredibly controlled credit losses. But the bears are waving a massive caution flag. They warned that a cyclical economic downturn could instantly shatter that beautiful negative 23% credit loss figure. If a recession hits, discretionary travel spending dries up, defaults rise, and suddenly funding all those luxury airport lounges becomes a really heavy anchor. If you want to grab a quick screenshot, consider this your ultimate cheat sheet for the American Express story right now. You can ignore the daily market noise. These are the metrics that matter. You've got $455.8 billion in spending, driving double-digit revenue and EPS growth. They're sitting on 155.1 million active cards, locking in 10% revenue growth for 2026, all while dropping credit loss provisions by 23%. The numbers prove they're crushing it right now. The true test going forward is simply whether they can keep this train rolling without letting expenses or defaults creep up. So I'm going to leave you with this final thought. If American consumers manage to stay strong, and Amex keeps pulling in these ultra-high spending customers, is this just a really great quarter, or are we literally watching the start of a massive new growth phase? They are betting the house that premium consumers will keep swiping. If that holds true, just how much bigger can this company get? Thank you so much for joining me on this explainer, and hey, definitely keep a close eye on those credit loss provisions.